Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, September 1st, 2023. Well, it finally happened. After 11 interest rate hikes over the past 18 months, the Fed finally succeeded in driving up the unemployment rate. And here, by the way, is just a list of those 11 hikes over the past 18 months. And you can see the Fed discount rate rather went from 0.5% to 5.5% over that span. That's a 500 basis point increase, which is huge. This morning, we learned that the U.S. unemployment rate jumped from 3.5% in July to 3.8% in August. That's the highest level since February 2022, shortly before the Fed began its current rate-raising cycle. And over here is that report. And on the left here, this chart here is the unemployment rate, and you see it tick up right here in August. And you got to go all the way back to February 2022, which coincidentally was also 3.8%. The chart on the right is monthly jobs added to the economy. Interesting trend. The last 3 months have been upward, but if you take a look at the entire chart going back 2 years, you would say the general trend is downward. The highs are lower, the lows are lower, but the last 3 months have been this steady stair-step increase. So we'll see if that continues. Somewhat surprisingly, the economy created more jobs in August than anticipated too. Last month, the U.S. economy added 187,000 jobs versus an estimate of 170,000. According to the Bureau of Labor Statistics, employment continued to trend up in healthcare, leisure and hospitality, social assistance, and construction. Employment in transportation and warehousing declined. Today's job report was a mixed message about the health of the economy. Anyone looking for proof that the economy is slowing down can point to a higher unemployment rate and decrease in employment in transportation and warehousing. But if you want to take the opposite side of that argument, focus on increasing jobs in construction and leisure and hospitality. Wall Street isn't sure what to make of it either. This morning, the S&P 500 index opened higher on that news, but then gave back all that gain and then some by noon. And here's the S&P 500 today. Way over here on the left is where it spiked up, and then you can just see a steady drop all the way down to almost exactly noon before it leveled off. The yield on the 10-year Treasury note initially fell on that news, but shot up 1/10 of a percentage point over the next couple of hours. And here's just today's chart. And way over here on the left, you can see it spiking up shortly after that news and staying up. Now, 1/10 of a percentage point may not sound like much, but in the bond market, that means something. Even the price of oil reacted strongly to that news. This morning, the price of a barrel of crude oil increased nearly $2 from yesterday's close to more than $85. That's the highest it's been since last November. Apparently, the energy markets believe that today's jobs report implies increased economic activity in the months to come, since increased economic activity correlates highly with more demand for energy. So here's today's chart of oil trending along right up until, again, here we are in the early morning hours, because these trade overseas, by the way. And then boom, report comes out our time, and it just shoots up. Now, if we take, year to date, we look out, this is the highest it's been this year. And again, if we go out trailing 12 months and we draw a line across where it is today, you got to go all the way back to last November. I haven't talked about the CBOE volatility index lately, but its behavior today is also worth noting. So I'm going to pull that up for you too. After this morning's jobs report, the so-called fear index fell to its lowest level in over a month. That suggests that professional portfolio managers on Wall Street interpret today's news as lessening the chances of a stock market recession this fall. And here's the VIX also dropping as soon as that report came out this morning. And again, we look year to date, and here it's at its lowest point. So apparently not much concern on Wall Street about this news either. But if that were true, then I'd expect to see the stock market moving higher today. Instead, all the major stock market indices are flat. Only the Russell 2000 index, which I'm going to show you here, is making meaningful headway today, up more than 1% this afternoon. And since small cap stocks are considered the most sensitive to economic activity, that suggests Wall Street believes the economy is expanding this quarter instead of contracting. Bear in mind, this is all happening the day before a 3-day holiday weekend. If the traders on Wall Street felt today's news implied an impending recession, they would either buy put options on the index, which would drive up the VIX, which isn't happening, or they'd be net sellers of stocks to reduce their exposure to a possible stock market correction, which isn't happening either. For all those reasons, I'm going to chalk up today's news as a non-event. There was nothing in it to push the financial market strongly one way or the other, and the data is too contradictory to fully support either side of the recession debate. That's today's PF video update, and I look forward to talking to you next week. Thank you.